5-star copies all. Go ahead. Message to observer. Alpha 3 rounds. AT delay in effect. 3 guns. Bravo 2 rounds. 2 guns. Smoke on effect.
Hey y'all, what's going on? This is Andrew from the Options Million community. Today we're going to be continuing the series from the Complete Guide to Volume Price Analysis book by Anna Colling. Fantastic book, fantastic resource. If you haven't already, go back and look at the first 2 videos from the series that I'll be doing. You can find those in the educational series playlist. Before we get started, if you haven't already, hit that like button and subscribe. Become a part of a great educational community. Not only do you get notifications for all future content, but you also get notifications for our Monday, Wednesday, Friday live streams. And during those streams, we do a little bit of live options trading and a lot of education to help you be a more profitable and consistent trader over the long haul. So in the last video, we kind of went over chapter 5 of the VPA book, which goes over accumulation and distribution. We're going to be building on exactly that and kind of going over how they elect to transfer the price action from accumulation to distribution. And that's through testing supply and demand. As I'm sure you already know, 2022 has been a very tumultuous market. We have dropped all the way from 4,800 all the way down as of today, 3622, 3613. It's been a very violent bear market, probably more violent than most people have seen in their entire trading career, certainly the most violent since 2008. And just looking at the price action, you can see what makes bear markets so difficult to trade. It's not as simple as putting on a put and riding it out for months and months and months just because the price action is going down. Because intertwined with the bear market, the big sell-off, are multiple, very strong, very violent bear market rallies. In order to navigate successfully this type of market, you have to know when to buy, when to sell, when to go long puts, when to go long calls, when to close out those positions. And obviously there's no real way to know exactly when that's going to happen. However, the number one tool we have to figure out what the institutions and dealers are doing is volume. So before we go down this rabbit hole, for one moment, I want you to take off your retail trading hat and put on your institution hat. I want you to think like an institution with billions of dollars of liquidity. What are their intentions? What are they looking to do? They're looking to drive the market to a target point and then load their shares and then move it back up to another target point so they could distribute or sell those shares on to other people, other institutions or retail traders. To counter the market against emotions, against fear mainly, to move the market in the most efficient way possible. So knowing this, we can start applying that lens to 2022. 2022 obviously has a lot of accumulation distribution phases repeated over and over again. Obviously back in January, we moved all the way down to 3,600, and here we are actually here in September after another sell-off campaign into accumulation, dropping from 4,300 down to 3,600. So applying what we already know about accumulation distribution, now that they've driven the market lower, the question everybody is asking right now is, are we going to continue to fall or are we going to bounce back up? Well, let's assume after 1, 2, 3, 4, 5 days of consolidation, and then Friday we drove a little bit lower, that they are ready to build the market back up. Let's say this is low enough and they're ready to build it back up, just theoretically speaking. Before they do that, they need to ensure that the market is ready to move higher, at least on a temporary scale, not maybe all the way up to new all-time highs, but maybe a little refresh back up to 3,900 or something, or even 3,800. They need to see that the market is ready to move back higher so they can distribute those shares back down. Well, they do that through testing supply. Supply is going to be above, demand is going to be below. And they're going to test the market back up ever so gently after a very fear-induced move to bring the market higher to see if they can actually break through supply and head back up. Now, the problem is when they do begin to move it back up right here into supply, which is roughly about right here, that is an area that was prior heavy selling action. You see here we tested, boom, we flushed it on down and now we're below. So in order to see if the market is ready to move back higher, we have to bring the market back up and test this level and see what kind of volume, keyword there, enters the market or doesn't enter the market when we get to this level. So they'll bounce the market back up, they'll bring it up, and they'll look for a test of this supply. When we hit this test level, they'll be looking for an influx of sell volume. If there is an influx of sell volume, then you could bet that the price will move right back down, and that test has been failed. It's called a high volume test. They do not want the market to show an incredibly high spike in sell volume because that just says that the market is not ready to move up higher. There's too many sellers in this market, and they may need to mark this market lower or bring it back down to test demand again to ensure that they're going to get all the selling action out of the market. They're going to remove all the sellers from the market, and that's their deal, is to strip all of the sellers from this market so they can efficiently move the market back up. So obviously, on the 20th of September, we had that test here, high volume. The buyers did step in, but there were still a lot of sellers there, obviously. They rejected it on back down. If you saw our analysis, we called this analysis perfect all throughout the week because of this exact cycle. And now, of course, Friday, due to the JP Morgan collar, due to a lot of global political events that were happening, they drove the market to new lows down to 36.01. So obviously that first test failed. And now we're coming up on another test at the bottom here to see if they're going to shake us out. So in the event that they bounce this thing back up, we'll have another test here of supply. And then once again, we'll be looking for another volume test. If they have another influx of sell volume, another high sell off back down, then once obviously the market is not ready to move higher. What they're looking for is what's called a low volume test. And they come up here, they move the market back up, and let's say they finally come up to supply roughly 3,700, 3,735, and we have a nice bottom wick, the green candle under low sell volume. What we're looking for is a kind of anticlimactic breach of this level that just kind of, all right, well, we're testing here, kind of testing, pinned here, and then boom, we just kind of mosey on through that level with no big spike in sell volume. And now it's just buyers, and now they know it's time to start pricing this market higher, and then they start bidding the market up. Now they have to do this little by little by little. They can't just start smashing the institutional bids to bid this market up, because obviously the market will know that, hey, something's going on here. The market will move up too fast too soon, and it'll scare all the people out of the market. So they have to do it little by little. They have to entice people, the retail traders who are once incredibly fearful. World's on fire, Twitter's burning, we're going all to heck. And now they need to entice those people back into the market to bid this market up. So they go little by little. And now people start to, all right, tensions are eased a little bit. People are easing. They bid this market back up a little bit. All right, so now we're consolidation, maybe a little bit of retracement coming back up. And now they can start getting people on board. And now they have to start creating willing buyers. And once they get high enough, they have those willing buyers. Now they can start to trap those buyers. That's when they start to distribute their shares somewhere up there, which we don't know where it is. That's their target. They start to distribute those shares onto retail traders. They start to dump those shares onto retail traders and then enter into the distribution phase, which most of that occurs at the top of the range, which is their target price. The problem with retail traders is that they are always driven by fear. Fear of losing more money on the way down, fear of missing out on the way up, and it causes them to jump into position. The second part of retail trader, and this is precisely why I told you ought to take off your retail cap and put on your institution cap, is because the retail traders usually wait way too long to enter calls. They wait way too long to start going long on the market. The market bounces, it comes all the way back up. Let's use the prior example. We have a big fear-induced sell in June. The market bids back up after some consolidation and testing supply, finally breaks out into distribution. People start going long up here. Twitter starts getting very bullish up here, not here. The institutions have already marked this market higher. People start, all right, well, hey, we're new all-time highs. The bear market's over. We're going new all-time highs. And then they start buying up here. And now we have all these trapped buyers. And the second we reach their target price, they start to massively distribute shares. And then down we go. And now we're providing trapped buyers. And now the fear is twice as much, because not only do we have the declining market conditions as presented by the media, but now you've got trapped buyers who are going to sell those shares back off. So watch for the volume spikes. Watch for the tests of supply in these particular examples. There are times to trade heavy. There are times to trade light. In my opinion, trading the consolidation areas like this up here, trading these flags, you have to play light, you have to play small, and you have to put stops on, because this is where they're going to do the max manipulation at these consolidation areas. This is where they're going to shake. The purpose here, the whole purpose is to manipulate and shake out the buyers. The whole purpose here is to manipulate and shake out the sellers so they could buy low and distribute high. That's the whole purpose of these consolidation shakeout phases. So in these areas, this is where people get chopped up. Not on these areas, in my opinion, but these areas, because they continue to try to go long and they get blown up. They continue to try to go long here, they get blown up. They continue to try to short here and bounces and they get blown up, so on and so forth. That's the whole shakeout phase. So in my opinion, play light, play small in the consolidation, and then let it fly on the trend moves. Now, I want to show you a great example of testing supply, breaking out, and entering into a bullish distribution trend. So obviously back in June, we had this crazy sell-off, 41.74 all the way down to 36.41. This is when by the way, I had that 1,500% gain. It's fantastic. I remember that. But you see, we did consolidate for what? 1, 2, 3, 4, 5, 6, 7 days where we kind of had some red, green, back and forth, bouncing off demand, rejecting supply. But look, we finally bounce off that final demand, a lot of high volume coming in as we shake out people. We start to bring the market higher. And look, here's that little test back up into supply. The volume dropped off a little more, but look at the next day. There's that big flush through all that supply. Look, the lowest candle nearly that we had almost all year. It's like the second or third lowest volume candle we had all year. Why? Zero sellers in this market. That tells us that the market is now void of any big institutional selling that's going to have an appetite to bring us lower, and we price the market higher. Now, we do have some profit taking after that, come off down, but look, now we're using the prior supply as demand. Now the buyers are sitting here defending this level as they do not have any more appetite to bring this market lower. We bounce back off, we consolidate, and then finally break higher. And then, of course, y'all remember what happened in July and August. We rallied up to about 4,300, providing a lot of liquidity to the upside on the buyer's market. So perfect example is that when we finally break through supply, which is, I would say, roughly, right about here, the lowest volume candle of the year, almost, second or third lowest volume breaks out. And that shows us that there's no more sellers remain in this market, and off we go. Now I want to show you an example of a failed supply test, or a big high volume failed supply test. And this is a perfect example. So back in March, we came on down. We had this nice little sell-off, which, remember, back in March, we were still kind of wide-eyed and bushy-tailed. We were believing that this was going to go to all-time highs. Things fell down here. We enter 1, 2, 3, 4, 5 days of consolidation right in this area, April 24th or April 14th. And now they finally bounce off demand again. We start to move up higher. We get this increase in volume here on the buy volume, which indicates, all right, well, there's still some volume in this market. We come up, we top wick, not a good sign if you're a bull. And then look at the next day, the following day. We finally get into supply. What happens immediately when we break into supply? Look at that. Candle right there. Come on down to this candle. Huge uptick in volume, the highest volume we've had in a couple of weeks. And then look what they do. They flush that market on down. Because that market, that tells us, because of the influx of volume here, the sell volume, that tells us that the market is not ready to go higher. So they have to mark the market lower. In this case, we wipe out the previous demand and we flush it lower to enter a new consolidation area down here. So if you are looking for the test in the supply, if you're looking for confirmation on a trend, then you don't need to wait any more than this candle. Wait for this candle of the break into supply and see what happens. After that, you're ready to make your move. So if this candle finished green with a bottom wick with low volume, I'd be looking to go long calls, 2 to 3 week dated calls, give or take, some aggressive yet realistic strikes on those calls. But right here, obviously, with this downside, now it's time to start scalping puts to the downside, or even take a closer dated put for a quick volatile move back down. But that's pretty much how you identify. You identify when we break into supply on the upside, look for the volume and see how the market responds once we're in that supply zone. Until then, in the consolidation phases, you have to play light, you have to play careful, because that's the shakeout phase. Only when we enter a trend and for the confirmation of volume do you start taking on the swing trades in this market. Now, what is the reason why I told you to take off your retail trading cap and put on your institution hat? It's because retail, one of the inherent flaws of the retail trader is that they wait too long for confirmation, which means they wait till take calls until up at the top or take puts at the bottom. And two, they are driven by fear, either fear of losing more money or fear of missing out. If you go look on Twitter, the sentiment shift on Twitter or across any social media platform for that matter lags way too long. The general population of retail traders in social media becomes bullish way too late in the cycle and bearish way too late in the cycle. Sure, there are going to be some people that are bullish way at the bottom. There's going to be some people that are bearish at the top. But the general population of retail investors, they like to wait too long. All right, hey, things are bouncing. Hey, it looks pretty good. Oh, okay. Oh, now I'm bullish. Let's smash calls, baby. Calls, baby. Oh, things are great. All to the moon. Bam, smashed. Or the other way around. All right, hey, things are good. So we're still going up higher. Things are great. Now it's a little retracement. Okay, all right, now the world's ending. Now we're getting fearful. Time to buy puts, baby. Long puts, 3,400, and enter puts, and bam, we get bounced. That's the way things work. They wait too long for confirmation. It's that kind of human mentality where it's the hot hand theory. We think the market's selling off, so it's going to continue to sell off. The market's bouncing, so it's going to continue to bounce. That type of thing. So the institutions play against that. And there's a great quote in the VPA book that says, buy when most people, including experts, are pessimistic, and sell when they are actively optimistic. Because that means that the market is about to counter those emotions and drive the market in the direction that they intend to their target price. So that's a little bit about testing supply. And that drives home two things so far that we've learned in this Chapter 5 VPA cycle, is that you've got accumulation and distribution, and then how they test out of accumulation and distribution. In the next video, we're going to be talking a little bit about how to identify their targets. Once they do break out, once they test supply or demand and break out or break down, what target are they going to go to? Obviously, that's a little bit more experience in science, but we are going to talk a little bit on the next video. So I hope you all enjoyed this video. Let me know if you have any questions down in the description of this video. Hit that like and follow button so you get notifications for all future content, as well as our Monday, Wednesday, Friday live streams. If you're not already, come down and join the Discord, the best educational server out there. We talk a lot about education. We go over volume price analysis on the daily, every day. If you don't already know, I've got a great podcast on Spotify called Making Millionaires. We discuss everything from emotional trading to navigating your personal finances, life, and everything in between. And as always, I'm Andrew with the Options Millionaire Community. Until next time, stay safe, stay profitable. I'm out. See ya.